things haven't changed that much. They're definitely better than what they were. Inflation's definitely a little bit more sticky than we'd hoped. But, there's no need for rate hikes just yet.
Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwi Bank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. Kia ora, welcome back to a new year, a new podcast episode, the first for the year. It is late January now, almost February. We haven't done one of these in a while, and there's been a lot going on globally, domestically. We have a bit to catch up on. There's been some good news, some bad news, quite a bit of bad news from time to time. Some of that bad news, actually, and this is going to be news for you guys today, is that MJ is leaving us soon.
I am. Yep. News very, very close to home. I'm leaving to Sydney. So I'm just going to be one of those statistics when you report on the New Zealanders leaving.
Oh my gosh.
That's just going to be me. I mean, I've really enjoyed my time at Kiwi Bank. It's just been so much fun. And I don't know if you can tell with the podcast, we just have so much fun doing our job. I mean, I think fundamentally it is because we're watching markets and how they, perform and everything. But it has been so much fun being at Kiwi Bank. The last 6 years have been pretty hectic. I think maybe with me leaving, it'll be a period of calm. Can I say that? Maybe you should knock on wood.
Yeah. And what's in store for Australia then?
Yeah, no. Sorry for the people I'm going to go see now.
The angel of chaos is landing.
Is arriving. But yeah, I'm heading over to Sydney.
Exciting.
Yeah.
Exciting.
It is exciting.
It's a fantastic opportunity. Like you have to do it, right? You've got to explore those international opportunities, and it's a great gig that you're going to, like, well deserved.
Yeah. So I'm still staying within markets, heading over to RBC capital markets. So it's same stuff. All I'm really expecting, and maybe this is the wrong thing it's just everything bigger is kind of the thing. The scale of everything is just larger. But yeah, heading over.
I think you're right. Like you go to Australia, everything's just times 10. Like it's just so much bigger. You'll love it. You'll absolutely love it.
Yeah.
It's such a good opportunity.
Yeah.
We're going to miss you though. This is the more important thing. Like, you've been with us for 6 years. It's been such a good
and you play a massive role in the team.
Yeah.
So it's going to be a tough adjustment period, but I mean, you're still here today, not to kick you out the door or anything, but now would be also a good time to mention that because MJ is leaving, we are hiring.
Yeah, we are. And we'll put the ad in the comments.
Oh, yeah.
If you want to sit there, like literally right there, get in touch.
Yeah. Anyways, we'll come back to talking a bit more about the position.
Yeah.
But
I'm not done.
Some of the news that we've been seeing domestically has been the inflation data that we got out last week. That's really what we're going to be talking about today. Yes, there's a lot of global stuff happening. I think we'll delve into that in the coming episodes, let that play out a little bit.
Yeah.
But really right now, what's driving, our domestic market and our focus has been what's happened to inflation in the past, to end the year, last year. So MJ, you were in the lockup.
Yeah.
One of your last lockups in New Zealand.
Yeah.
Tell us how you found it. Well, we were both in there together.
And what a way to finish the inflation. It was actually quite an interesting time in the lockup. We were really it was an interesting one because it came in hotter than expected. Inflation rose to 3.1%. We were expecting it to just kind of stick around 3% at the headline, but it came in a little bit hotter and we were trying to figure out why, and we couldn't really pin it down to just council rates or fuel prices that we had seen in the past. It kind of felt like it was a bit more broad-based, and when you look at things like core inflation, when you exclude all that volatility, it kind of reflects that assumption there. So it was a bit more broad-based. So you could really feel you couldn't feel the time pass with that one. It was just like you're in and out. It was an interesting lockup.
Yeah, I mean, it was probably, I don't usually go to the inflation lockups. I'm usually there for the GDP ones. And so I was already kind of in there a little bit more nervous than usual. And I just remember flipping the page and going, ooh, 3.1, that's a bit hotter than we were expecting. We were expecting 3%. And then I turn the page again and I go, oh, tradables inflation, that's a bit hotter than we were expecting. Then I look to the next column and it goes, oh, non-tradables inflation, domestic inflation, that hasn't budged at all. Turn a page again, core inflation, that hasn't budged at all either. And it really actually freaked me out for a second. I was like, what is going on here? And it is that sort of broad-based strength in some of the areas that we did see. But yeah, like really delving into it, it's a lot of disappointment and frustration in that domestic inflation, those core inflation numbers. I mean, what did you think, Jarrod?
Well, yeah, I mean, those are the numbers that we, had forecast to be easing and getting closer to 2% in time. It just looks like it's going to be a little bit longer before we get there. So, yeah, I mean, you look at those numbers, and as you say, they're more broad-based. Inflation's more of a problem than we thought, and it's caused quite a few economists to change their calls. Some are calling for rate hikes at the end of this year. I personally think that's premature. I think it's too early to call victory on the recovery. And just because we've had an awkward inflation print, I think the conditions are still there for inflation to get back to 2, particularly when you look at stuff like rents, which have eased.
Yeah, exactly. I think the inflation we're seeing, we'd be reluctant to say that it's being driven by this rebound in demand just yet. Things like services inflation still cooling. It's still quite elevated, but it is in this broad downtrend, which is your kind of indicator of demand in the economy. So that's still quite soft. Rents are really soft. It's just that we've had some big gains over the last year, and as those fall out of the calculations and the fact that our output gap is still negative, there is still that trend back to 2%. So we are expecting it to go back towards 2% this year. Below 2%, maybe not, just because we are starting from a higher base. So we're further away from that. But I think the trend is still to 2%. So I think, you're right. The call for a change in policy this year is as early as September does seem a bit early.
I think it's very, very low. I mean, the market, so economists have changed their call, and most are just going for one hike this year. In that last quarter of the year. Fine, whatever. I still think it's a bit early. Markets are even further ahead, right? They have 2 full rate hikes priced in the second half of this year, and I just think that's premature. It's way too early to call. We were, 4 months ago, 3 months ago, we were all screaming for rate cuts. Things haven't changed that much. They're definitely better than what they were. Inflation's definitely a little bit more sticky than we'd hoped. But, there's no need for rate hikes just yet.
I think what maybe complicates things, I don't know if that complicates is the right word, but we've had the new governor come in and she said that she's laser focused on inflation, and obviously inflation is outside their target band of 1 to 3%. Hopefully that laser focus is also on its outlook, right? Not just on that single print.
Well, I mean, she has to be laser focused on it. That's her mandate. To come out and say anything else is like, well, haven't you read the first page of your job description? So, I mean, I think she'll say that. And I think, she still has time, in my opinion, before she really has to make any decisions. Like February, just learn what's happening. And then by the middle of the year, you start thinking, okay, are we getting close to a hike or not? There's no need to rush this stuff, I don't think.
Yeah, absolutely. Because even though the data has improved and the CPI print isn't the first sign that we're seeing that things are improving, which is encouraging. Earlier in the year we had NZIER's quarterly survey of business opinion. That was quite a strong read as well. I think businesses were feeling the most confident that they have around the general outlook since 2014. That bodes well, and their sort of trading activity had also improved in the survey, which was quite key. Investment and employment intentions had also lifted. That all kind of feeds into the story that, the recovery that we sort of started to see in the tail end of last year, it's sort of gathering that momentum now. But indeed, it is a bit too early to say that, we can kind of put our foot down and say, that inflation, is actually coming back now. one of the interesting areas that we saw a bit more price strength was actually across retailing goods and discounting.
That surprised me,
Yeah.
actually. I thought the discounts over that sort of Black Friday, Boxing Day period were quite hefty, but
well, typically
obviously not.
the December quarter is seasonally quite a soft one because
Yeah.
you've got lower food prices because, better weather, better growing conditions. And then also because of that discounting that you get, whether it's Black Friday, whether it's your lead up to Christmas sales, whether it's Boxing Day. But we just didn't really see that this time around. Looking at the percentage of firms who had discounted prices in 2024 versus 2025, that had fallen. I think we saw 20% of prices had fallen in December 2024 versus 15%. And the actual size of the discounting has actually fallen as well.
Yeah. So you're saying that we've got fewer items that were discounted this time around, and the discounting that did take place was even smaller, right?
Yeah, particularly in that furniture group, right?
Yeah.
It's like you walk into a store and it's like up to 70% off. It's like, oh, what's 70% off? Something like some pencil in the corner. The rest of the store
just marked as problem.
Yeah.
But yeah. But I think it kind of was in line with what we were seeing in Black Friday. I mean, our last episode covering that consumer spending, we were saying how it didn't seem maybe as widespread. The big sales we did see weren't as widespread.
Yeah.
And that's, I guess, fallen through with what we've seen in this inflation report.
Yeah, definitely. We definitely called it out that we were like, these sales are not it. But again, I don't think you can really look at that and go, oh, it's because, the demand's back on for these items. Because actually, I mean, we haven't gone for our Kiwi Bank data just yet, but, some of the things that we've seen is that actually retailing of December wasn't as strong as a lot of the retailers hoped that they would be. And Boxing Day actually disappointed for a lot of people, especially relative to Black Friday. But there is still this absence of that demand isn't fully there yet. So it does seem like maybe it is more of a cost-driven push up in prices. Looking at that QSBO survey, demand was still coming in as the main factor constraining businesses, your lack of sales. So I don't think it's that demand piece of the puzzle here. It's probably more that rising costs that were reported in the survey as well. So...
Plus, I mean, if we look forward, I think our outlook still holds. There's still an election coming, and I think there is legitimate concern around this election. And the fact that we're running, below par in the economy, I think that makes people even more nervous. So if you're thinking of investors, they're worried about the election and different election outcomes, whether it's investors in property or commercial or other things. I think there's a real fear out there. I keep hearing about it even now. But look, we take the lift in confidence as a good thing, just as we saw it last year and the year before, but it didn't come into didn't translate into activity. This time it looks like it is actually feeding into activity, particularly on some of the high frequency data that we get to play around with. We still need, probably a good year before we can actually say the New Zealand economy really has recovered, right? So for me, that's the way I'm thinking about it. Yes, we've seen a lot of good data out recently, which is nice. Yes, inflation's running a little bit higher than we'd thought, which is not nice. Do we need rate hikes? No, not for a long time.
We need to have this accommodative setting run for a little bit longer, right? To kind of have that confidence really do translate into that activity, which is what we want in an election year where people are already quite cautious about making investment plans and everything. Again, we also need to see the labour market turn to really be sure that this economy, it is the last.
And that's a lagging
it
indicator,
is,
isn't it? Yeah.
So we need to see that to really be sure that, okay, we are on this path to recovery, which we are. It's just to see that continue, right?
Yeah. And your point around demand driven inflation and supply driven stuff, this looking and feeling a lot more like supply is something that you should be looking through from a policy perspective. have we overstimulated demand, which is driving prices? I don't think so. Like, so that's probably a story for much later in the year and into next year. So yeah, look through it.
And even if you were a little bit worried about, have we overstimulated a little bit, which, that's not what we think, you could kind of argue, actually, we've had a bit of a tightening in financial conditions anyways.
We have.
At the end of last year, following the Reserve Bank's November MPF, when wholesale rates, went 20, 30 basis points higher. And we're actually back, if we look at the 2-year swap rate, we're back to those December highs off the back of this good data and also the CPI print. But, banks responded and they've actually they've lifted their rates as well. So financial conditions have actually tightened already without the need of a rate hike. And so you could actually argue that, we've taken out some of that stimulus anyways.
Yeah. Yeah. I think we covered that in our last podcast, how wholesale rates have moved. So all rates have moved higher. And it's basically just a market going from pricing in rate cuts to hikes. And so that's such a large swing in your short-dated interest rates. But we were updating our forecast this morning on the swap rates that we forecast, and our 1 and 2 year rates were pretty close, the forecast, but the 5 and 10 year much higher. Right, we've seen a big move in yields globally, so we've even got a steeper curve, which I do think reflects sort of better growth and inflation outcomes. So if there was one thing in that report that sort of stuck out to you, what was it?
It would be in housing, not rents. Rents came in as expected, soft.
Yeah.
Very soft, actually. It was in the construction costs. It started to have a bit of an uptick in December. Still running at well over a decade lows, but it had lifted over December to be 1.2% over the year.
Yeah.
Which is, that is still quite low. Stats NZ, they kind of gave a little bit of color around why we saw that uplift. And like we've been saying, it wasn't really a change in market conditions. So demand wasn't really what's lifting that. It was around the contracts and labor costs being higher?
Building components is what they said. Right. And they mentioned fittings, subcontractor charges, power up, which we know power was a big one up over the year anyway, so you can see how that's flowing through. But it is just going back to that. It's a supply side. It's a cost-driven inflation as opposed to demand. Nothing in their survey had really pointed to a change in construction demand outlook or anything like that. In fact, if we look at the housing market, it hasn't really changed that much. We ended the year on a bit of a better note, but really it's still that same story of a sluggish housing market. So it was weird to see those construction costs lift, just given that, the demand hasn't changed, but it is just coming down to those cost inputs.
Yeah. We expected softness to continue, right, in construction, given the quite bad recession we've had in construction and retailing. So that's interesting, right? Maybe it just gets to a point where you have to pass on these costs or you're done, right? So firms just passing it on.
Anecdotally, haven't you been hearing that tradies are still kind of asking, calling out for work? It's just been quite quiet. So you can't take this as a demand shift, really.
Yeah, but those tradies must be passing on higher costs, or otherwise,
just can't continue.
You can't continue,
It was a little bit weird though, because in that QSBO survey, a smaller share of firms had reported increased costs over the quarter. I think it was down from a net 55% to a net 30-ish%. So it was it was surprising because there were still some, building firms saying that they were seeing, I guess, less costs. And also, by the way, about that rental point, because we've brought it up a couple of times, and we're talking about how they're quite low. It's the weakest increase since the start of 2014.
Yeah.
Right.
For rental inflation.
And it's negative on the year, right? It's down.
No. It's eased to 1.9%.
Oh, 1.9.
No, we haven't had. If we had some, deflation in the rental space, it would actually probably have a really big impact.
Much larger impact.
And we would see the headline much lower because I think rent is the largest single item in the basket in terms of weighting. So having a bit of deflation there would actually be quite good, but we just haven't quite got into deflation there.
We can't be far away because I think it was the RBNZ that were reporting rents were down in Auckland.
Yeah, I think.
Right, and it's definitely down in Wellington. So, there's your two
It'll show up.
It'll show up somehow,
I think so.
I mean, we might get there. I mean, I think the quarterly increase was just 0.2% over the quarter.
Yeah,
I think the
yeah.
quarter before was 0.1. Like, it is really small
Highly
increases,
unlikely,
but
still.
yeah.
Interesting stuff.
Mm.
Yeah. So in terms of our outlook, 26 still a year of recovery, we hope.
Mm-hmm.
Inflation starting off a little higher than we thought, but not the end of the story. And then looking for RBNZ action in 2027, not 26.
Yeah. Be good to watch the inflation expectations survey.
Will it move higher?
Yeah. When is that? Like the end of, or maybe mid-Feb?
I literally filled it out this morning.
Oh, you filled it out?
Yeah.
Yeah. Oh, okay. Coming soon.
I'm the one that puts in the minus 2%. Just
swaying the results.
Yeah, swaying the results. I get cut off with a trimmed mini.
Yeah.
All right. So on to other matters.
Mm-hmm. Should I step out?
No, we need you to sell the role.
Yeah, you got to sell a role.
Should I? Because, I mean, you really would be crazy not to apply for this job. It is really, really interesting. And it's just, you get to, if you're coming from an economics background where you've learned it all at school, you just get to throw that textbook out the window.
Yeah, absolutely.
And get to see this all play out in real life. So if you want to do that, apply.
So you've been with us for 6 years.
Yeah.
You started the end of 2019.
Yeah.
About the time someone discovered a virus somewhere.
Yeah.
And then you and I got chatting about
Yeah.
the 2008 financial crisis,
Yeah.
which was my crisis. I loved it, lived it. And you said to me, what?
I messaged you. I think you were on the road. I just sent you a Economist article. I do remember this quite well, and it was something around the GFC.
Oh,
and
that's right.
Yeah,
spin-off.
yeah, it was just something around then. I said, you lived it. I was learning it at school. I wonder when it'll be my turn to have a crisis to kind of talk about. And then a couple weeks later, we were in lockdown, and the whole country just unprecedented lockdown around the world, seeing France close their schools and all these just headline after headline. And it was probably the best way to learn about the economy through the crisis, to see the economy kind of come apart and trying to fix it. Talks about a negative interest rate. What else did I see? We saw the Kiwi Aussie go to parity at one point. Swaps traded negative, oil traded negative. Honestly, this job, I should probably just retire now. Yeah. Or just fell.
Write a book.
Yeah. Yeah, when we were talking about wholesale interest rates falling to, well, when the cash rate was going to potentially go below zero, and they had to get banks prepared for that. Remember?
Yeah.
Took screenshots of all of that. So if you do love the mayhem of markets, this is the perfect job, really.
It is pretty cool.
Yeah.
And we're so in tune with the bank. Like during COVID, we were presenting to the board every morning for quite a while, right? That was the panic station. We were in the war room with the board talking about how does the bank navigate their way through something which we've never seen before. There's no let's go back to the last time
there's no history for that.
No, like Spanish flu or whatever. I don't know. There wasn't anything for it, right?
No.
Whereas I'll talk to the board probably once or twice a year.
Yeah.
So speaking to them on a daily basis is
it's something that has to be very stressful. Yeah.
Yeah.
And then I just honestly, this could be an episode in its own because I remember our dealing room meetings would also become daily and quite early because just you'd have markets be awake and something had happened. The Fed had announced something or the US announced something with the ECB, just daily announcements that you had to keep on top of.
Yeah.
And it was crazy. And then you'd be saying numbers that were really crazy as well, like swaps were up 10% or yields were up 10% in a day, or, the US lost 1 million jobs in a week.
That
and
was
it's
crazy.
just, So
And then you were around for the sugar-induced
Oh, yeah,
rush
and
as
the
well too.
other way around, yeah.
Then the complete opposite way,
Yeah.
to come crashing back down again.
Yeah.
So
It really
6 years you've had 3 cycles.
Yeah, so
Yeah.
maybe I should just retire. I've seen
and
it
so
all.
this is how she got the nickname Angel of Chaos.
Yeah, exactly.
And we're now looking for another angel, particularly, hopefully not
Maybe
of
not.
chaos.
Not of chaos this time. Angel of stability.
Of calm, yeah.
Yeah. Angel of slow, long.
Yeah. Good growth.
And so-
That's it.
Okay, in all seriousness, what's the kind of person that we're after for people who might be listening, be like, yeah, I'm keen, what are we really looking for?
Yeah, good call. So we'd love someone who's obviously got a degree in economics or finance. If it's accounting, I'm sorry, you don't have the right personality. We do want someone with a sense of humour to come in, and I think you need one when you're working on a trading floor like ours. But you just got to love economics. I mean, the fact you listen to this podcast is probably a good sign, and just a real love of the job. You will, if you love economics and you love following markets, I think you'll love this role. We do have a lot of fun. Yeah. What do you think we're looking for?
No,
How would you put it?
I think the number one thing is that we're pretty flexible on like qualifications,
Yes,
things
sorry.
like that. It's like, as you said, it's really about that personality and your passion more than anything, because your passion will take you where you need to go. There's a lot to learn on the job, but that can all be taught and learnt as you experience, crisis after boom after crisis. Probably not in 6 years, hopefully not.
Yeah.
But there's a lot to learn, but, you can start with a passion. So,
Yeah. I mean, I got onto the Reserve Bank's website when I was 13, 14 and subscribed to monetary policy statements. So you don't need to love it quite as much as me, but maybe if you did enjoy your economics course at school, you went on and did a degree, that's great. That's your foot's in the door. We all want to have a master's. So we got our master's before we started. You're doing your master's now. So that's kind of the level that we would love everyone at. That master's gives you that research bit. And then from that point on, it really is just a passion for the job, right? You'll find yourself coming in here at 8 in the morning and we have meetings. We have so many things happening during the day, but no day is the same as the other. We're flexible, so come in 2, 3, 4, 5 days a week. If you want, work from home, 2 or 3 days as well. There's a lot of flexibility in the role. There's a little bit of travel, but that won't come for a while because Sabrina will be soaking that up now.
yeah.
That, and also what's really fun about the job is you sit on the dealing room or on the trading floor. We're talking to financial markets.
Yeah.
And so the environment is just very fun. Very fun.
Yeah. So if something breaks, there's a news break, and then you've got people behind you wanting to know what's going on.
Yeah.
The CPI report comes out hotter than expected. You see swap rates popping higher. You see the Kiwi dollar popping high. You've got traders, riding that wave. It is a lot of fun.
Yeah, it is.
So please apply if you can.
All right. Well, I think that wraps us up for this week.
How many more weeks have we got with you?
I've got 2 more.
Only two more.
Only 2 more.
If there's anything you're burning to ask MJ, now's the time. Send through your questions. We've got her great mind for 2 more episodes.
Yep. Just 2.
No. I'm not accepting your resignation. I've changed my
I
mind.
asked you to, resign it.
Yeah, okay, we can. I reckon we can. Get ourselves an employment lawyer.
Yeah.
Someone with a sharkskin suit, gold in his teeth.
All right. Stay tuned for whether we manage to keep MJ on board. But we'll catch you next week. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwi Bank.